Hi, David Hall here. I get asked in my coaching and consulting about acquiring a business and what to look for in the financial statements that you get. In general, sellers will price their businesses, especially service businesses, based on net income and a multiple of that net income. So as an example, if the seller is making $200,000 profit a year, then a multiple of 2 would be 400,000 and asking price would be 400,000. So the trick here is to know that because of the multiplier being based on income, that number is key to making sure that you're paying the right price. So in other words, the seller has an incentive, if you will, to bump up the net income and make things look a little better than they actually are. So how do you find out if a seller is telling you the truth on the numbers? All right, there are several factors. Number one, make sure that you ask for the balance sheets on the P&L, or balance sheets on the financials as well, not just the P&Ls. So you want a beginning balance sheet, a financial statement or an income statement, a balance sheet, and an income statement and a balance sheet. So you want to bookend each financial statement or each P&L by 2 balance sheets, one beginning and one ending. Why? Because that's the only way you know that you're getting a full picture of the business. All right. Number 2, when you get financial statements, compare it against the tax returns that are prepared by the seller. A lot of times those numbers will be different. And there's a good reason, because in businesses, you will put numbers in that you don't reflect in a tax return. Okay. As an example, when you buy equipment, all right, those are assets, and you don't reflect those in the tax returns. Whereas you might reflect them as an expense in business. So you have to be aware of why a financial statement might be different from a tax return, and just make sure that you understand those differences. In general, a tax return is going to be more effective in terms of understanding what the true bottom line is than a financial statement. Why is that? Because we all try to minimize our taxes when we file tax returns. So you're going to have, again, the seller in that case is the incentive is to get the number as low as possible so they can pay the least amount in tax. Conversely, when the seller is selling, he wants to make the income look really extra special good. So just keep that in mind. Another big deal, what I've seen it with businesses, is that they'll have a tendency to record income that actually should be recorded as a liability. What am I talking about? If you get paid in advance for services rendered, you should not record that as income. You should record it as a liability. As an example, I was looking to buy a construction contractor just last year, and this contractor would collect money in advance on business deals or on contract work. And he would actually siphon the money out of the business, and there would be no cash left. And yet he would still have an obligation to do the work in the future. But he recorded that money as income. Well, I very kindly or very nicely told him, you can't do that. You have to record that as a liability. The bottom line is he never got that, and he insisted that money was income. Again, I see that a lot, and entrepreneurs tend to think cash basis income. So make sure that you have analyzed those revenue figures to factor out, if you will, the customer deposits. So an adjustment needs to be made for that. And actually, just to kind of finish that discussion, it actually needs to be made on both sides. So in the current year, you actually take it out of revenue. In the first year that you're analyzing, let's say it's based on 3 years of activity. In the third year back, you actually add back in revenue that was earned in that year that had been collected in the previous year. So it sounds a little complicated, really not that complicated. You just need to adjust it on the front end and the back end. An accountant is going to best serve you to make those adjustments. Finally, just a discussion about accrual versus cash basis. In general, you want to use accrual basis financials because accrual is the only true understanding of the bottom line. Again, what am I talking about here? There are many times that you incur expenses that you don't pay until a later period. Conversely, again, we talked about the customer deposits. You might collect money on revenue that has to be performed in the future. Those all need to be adjusted to accrual basis rather than cash basis. This is the only true understanding of accounting. And again, because most service businesses are based on a multiple of profit, you want to make sure that you adjust that to accrual basis. So if you are buying a business, number one, as I'm sure you can understand after listening to this, get a good accountant, an accountant that really understands financials, that understands the differences between financial statements and tax returns, and make sure that he knows how to make those adjustments so that you can have the right number to start negotiating from. It's hard enough to buy a business without that, but if you don't have a good number to start with, you're never going to make a good decision on buying a business. So one other thing that you want to look at when you're buying a business is this concept called add backs. A seller will generally add back certain expense items that he or she deems discretionary. And what we're talking about here are expenses like if money was paid to a charity, as an example, that would not be something that would be required of a business to do, but it might just to be done because the seller wanted to throw some money to the charity. So that's a common example of an add back. But the trick here is you want to make sure that you are all over those items that he is putting in as add back, because he's building up his profit basically because of those items. So they're very key in terms of you as a buyer understanding what's really happening there. If I were buying, I would make sure that any add backs, I would look at the underlying documentation to really see that those items are what they say they are instead of being some normal operating expense. So just keep that in mind as you're looking at a business. Again, a good accountant, financial accountant, auditor would be even better. An auditor is best to look at financial statements for really understanding what is true and what is being manipulated. So again, my name is David Hall. I'm the founder of the Breakthrough Coaching Program. I coach business entrepreneurs to getting bigger results and just having a more effective life. If you want to know more about me or our program, please go to mybreakthroughcoach.com and you'll find more information about myself, the coaching program, and links on how to connect with us. Thank you, and I wish you the best with your business.